Hey guys, how are you mad lads doing on this fine morning? I hope you are all having a great morning because let me tell you, this week we are hitting back strong with morning videos. We covered housing, which I still haven't even finished covering all the subjects I want to share. We covered why Wall Street gets away with criminal acts, and then we talked about how 1971 changed everything. What we haven't yet brought up is healthcare, especially in the United States. This one is long overdue, and a lot of research has been done to bring you guys some crazy, and I mean Ted Bundy levels of crazy, statistics and facts that ought to shake you guys out of some comfort zones. As usual, I have a couple videos regarding this very complex topic, and I like to warm myself into such broad and dynamic subjects, so we are going to keep it simple, relaxed and a bit depressing as has become the common courtesy of this morning routine. Shout out to Heather Perlberg for bringing light to this issue. Her research and well-written journalism have inspired me to do this video, and most of what I say is built upon her vast work. Thank you, Heather. This video is a bit long, but I ask you to stick around because some of the stuff, especially towards the end, is pretty mind-blowing. I want to jump right into it, so quickly before we get started with today's segment, let me disclose and state that I am not a financial analyst or advisor, and that all contents discussed in this video are provided as opinions. All efforts are placed to better understand the nature of the current market in anticipation of the greatest squeeze in financial history. Everything presented is evidence I collect, and all opinions are based on research, experience and knowledge on the matter. Shout out to all my Patreons and one-time donors, who continue to support and carry this channel into greatness. Alright, let's get started. Healthcare in America sucks. Extremely lucky are the ones who have it, even if it's not that good. The reality is that our entire healthcare industry has become vampires, and not only are they sucking Americans dry, but they are working harder than ever to ensure that you stay sick. Now, I am jumping the gun a little bit with this statement, because proof of this will be reserved for a later video, but I do bring it up first and forefront because in the land of the free, you cannot be a blood-sucking vampire without leaving traces that lead up to insolent mongers at Wall Street. In fact, pretty much all the problems in our healthcare industry denote the same vicious nature that we have familiarized ourselves with through the housing crisis taking place in the world. It would be easy for me to say they are raising prices for everything, investing in treatment to not find the cures and call it a day, leaving you guys pleased with the self-fulfilling prophecy of knowing what to expect. Almost all conversations surrounding this topic are like that, and as such, I am to break the wheel, which is why I must ask you guys to try to erase your biases and what you might know about the healthcare industry, and instead come to these videos with a clear state of mind. We are starting from the very center of everything and we are going to expand, giving you full statistical facts as to how private investors are tainting the most vulnerable in our society. With this little notice all said and done, I say it's time we actually got the party started. Without any doubt, we need to talk about the growth of influence by investors and private equity in our doctors' offices. During 2020, when everything halted and restrictions were placed to try to contain the growth of the virus, many medical offices around the country were advised to shut down. This is because a great many, if not the majority, of medical procedures were characterized as non-essential. That is, things like cosmetic surgery or dermatology checkups are examples of practices that aren't at the forefront of importance when the country was trying to contain the situation. As such, many offices were shut down, putting many doctors and their staff in a bit of a tight spot. The focus became on how to apply for government funds to survive and keep payrolls going out. A particular case in California comes to mind. A Zoom took place with more than 170 dermatologists from all around the country. Among them, a doctor named Greg Morgenroth attended the meeting. Morgenroth is the CEO of the California Skin Institute. This institute has expanded to over 40 locations ever since its inception in 2007, and has become a very well-known example of the financial strategy by which private equity is using to grow its pockets. For the institute in particular, Morgenroth received a loan from Goldman Sachs that could convert into an equity stake. To the surprise of no one, the California Skin Institute became the biggest dermatology chain in the entire state of California. This has a lot of implications, but more on that later. Let's continue where we left off. So, Dr. Morgenroth attends this meeting with over 170 other dermatologists who intended on finding and sharing strategies to best combat the dire circumstances that were presented to them as part of the government restrictions that were placed. As doctors took turns, when the time came for Dr. Morgenroth to give his thoughts, his words shocked everyone into silence. He countered what the general approach of everyone, defiantly stating that instead of opting to close offices to abide by the restrictions, the doctors should consider staying open, basing this argument on that everyone was over-interpreting the guidelines being set. Many started raising objections to this, but Morgenroth insisted that they had a job to make strategic plans that would enable them to survive and rebound. The famous California Skin Institute was working non-stop, with all hands on deck at the phones, dialing customers and reminded them that even regardless of where they lived, even the worst hit areas, they still had to show up for appointments and procedures. Morgenroth went as far as to compare Botox surgeries as being equal to a grocery store selling candy on the staples in the sense that they offer products and services that, though not of most importance at a given moment, there is no real reason as for why they should stop offering both. By his logic, a store can offer meat, bread and milk while offering candy. Why should medical offices only offer virus-related services when they can be at full capacity offering all the services they had? He did not see the growth of the virus as a good enough reason to shut down certain services, regardless of their necessity or the effect it might have in setting back efforts to contain the problem. Upon reading this story, I came to understand some of the sentiment. Indeed, I have always been a man to view both sides of the coin, and been immune to many takes that might have too much tribalism. I understand the government's efforts to contain such a chaotic situation while sympathizing with small business owners who worry about how to pay the bills. There is something about this story, however, that raised my attention. There was an almost unsusceptible mark in the careful wording that Dr. Morgenroth used that has become oddly familiar during these past couple of months, and it made me dig deeper. The behavior and general approach of this doctor, and therefore his institute, is almost the same blueprint which we have become too familiar as to how Wall Street handles any type of crisis into an advantage. They have engineered every variable to maximize profits, whether as medical practices to hospital billings. No stone will be left unturned if a nickel can be raised. To be more exact, the explosive growth that private equity firms have enjoyed in the healthcare industry has led them to do something most of you have not even anticipated. They started by buying up medical offices, and have now expanded to buying physician staffing companies, surgery centers and anything in between. They aren't just giving loans to medical offices. See, that is a bit of an antiquated model. Why profit for a couple of years when you can start buying up equity in companies, then slowly grow them until you outright own everything, essentially starting the same monopolizing strategic model that we have seen in other areas of the economy like the housing market. If you are still watching this video, I know you were already hooked into this topic, so let's dive a little deeper and really start looking at some models and figures. We know that in the ever-growing superficial society that we live in, social media has amplified insecurities in everyone. Because we are constantly being shown highlight reels of perfect-looking people, we feel a great burden to maintain and prioritize our looks. An industry seeing a boom in recent years has been dermatology, because people in America are ever increasingly anxious about aging and looking old. In the past 5 years, private equity firms from Wall Street and other sectors of the world have invested over $10 billion in medical practices. We have the relatively younger generations coming in larger droves to get treatment to prevent wrinkles and sun damage, but the real lucrative customer are the boomers, whose conditions offer crazy amounts of potential profits. Skin cancer is a horribly thing to have, and it gives Wall Street institutions the biggest hard-on you could ever imagine, even giving Johnny Sins a run for his money. This has caused private equity firms to expand on the dermatology market. In fact, the rate of expansion in dermatology is so high that we have credible estimations of private equity ownership owning more than 10% of the entire United States dermatology market. Let that sink in for a minute. And you think they are stopping at dermatology? Private equity firms have already started expanding into other specialties including women's health, urology and even gastroenterology. This is extremely dangerous, and let me tell you why in case you cannot formulate a coherent reason. In medicine, you are directly dealing with people's lives and health. You cannot serve two sources whose interest is on opposite spectrums. With private equity buying more and more, they are expecting and demanding annualized returns of 20 to 30% within 3 to 5 years. If you don't meet demands, you can kiss your job goodbye or your office can and most likely will get buried under. Competition is very strong, and those making good on the demands are able to have enough funds to take out competition. Of course, investment firms are saying any concern about this is unwarranted and overblown, citing critics as being overdramatic for clicks. However, numbers are not on their side, and right now they all point to a trajectory of more Wall Street ownership of the health market, and less ownership and profits for offices that decide not to take private equity money. But the problem gets even worse than this. Knowing that this is a situation with a ticking timer before the media and social media start talking about this, Wall Street has anticipated what's around the corner and have taken preventative measures to make it almost impossible to track the impact they have on the industry. First, they don't disclose investments that they make, and then they force their newly partnered doctors into non-disclosure agreements. However, some have come out to some media outlets in secret and given their own testimony along with court filings and records to give us a glimpse as to what they experience. The pattern generally follows a 5-step system. The first step involves investors buying up medical practices without technically owning them. You see, the American Medical Association along with the law, have prohibited for-profit investors from buying out doctors' office. So, Wall Street has devised a way around this. They have tasked their lawyers without architecting a way to allow them to have ownership and presence in decision-making while bypassing the law using careful technicalities. For example, when an investment firm buys out a doctor's office, they are actually buying non-clinical assets. Physicians still remain the authority behind all medical decisions, at least on paper. In the real world, investors get influence and presence over all medical decision-making. The typical way things go is that after a substantial acquisition takes place, which typically involve multiple doctors and locations in a particular area, private equity starts enticing the best lucrative doctors in the entire region. After a while, they start expanding, but this time, they buy out small offices in the outer regions that are not as well known or as profitable. This gives the entire group a regional presence overall. This is done with one goal in mind: to lower the cost of buying medical supplies in bulk while also renegotiating higher insurance rates. Funny enough, Wall Street owns large amounts of the insurance world, so it makes sense for them to do this to drive ever further profits to their never-ending pockets. Funny enough, one dermatologist who ironically sold her practice to the previously mentioned California Skin Institute stated that she got caught by surprise when the payouts went from $25 all the way to $125 per visit. Doctors are initially thrilled when they are bought out, as cash is usually offered in a relatively large amount. However, the effect that this has in the long run comes back to haunt them and anyone else remaining in the industry, as you are about to find out in a couple of minutes. So physical expansion is established as well as a relationship with doctors in the area. As such, the next step is all about drawing in new customers. New management elected by private equity tend to introduce scorecards, goals and bonus programs that encourage staff to do as many procedures as possible. Allegations by some companies allege that medical assistants responded to the bonus structures by checking off extra boxes on examination reports, giving the impression that doctors had checked more areas of the bodies, which leads to higher patient bills that indirectly but certainly defraud the government under the Medicare program. The problem is so bad lawsuits have already been filed, but once again, in the most frustrating outcome of all, the case was dismissed after the federal government declined to join. Once growth is accelerated and quotas are placed, comes the next step in the major plan. This is where cost-cutting occurs. Private equity loves to cut corners wherever they can, and cheap soap or toilet paper is not the only places they love to cut cost. We are seeing doctors secretly disclose that regional managers placed by private equity are opting for cheaper products for patient care, such as needles and sutures, without even consulting medical staff. The quality of some of these instruments is so poor that they often break apart inside the patient's bodies. Medical staff would have to do invasive procedures sometimes to dig out and extract needles. The cost-cutting also comes in the form of quality for patient care. Doctors who sign agreements also disclose that they will never compromise on medical judgment, but management has begun to intervene in this area too. Left and right, we are seeing many medical professionals complain that management is forcing them to see as many as twice as many patients a day, which makes them feel rushed and unable to provide the same quality of care. In fact, it has gotten so bad that management is actually having meetings now asking doctors why they aren't sending more patients for surgery. Guys, let me say this again. Non-medical staff in upper management is demanding that doctors rush or force patients into surgery even if they don't need them because surgery is a highly profitable margin. The fourth step's coming in cutting costs for even more critical supplied. I am talking about going as far as replacing reversal agents which tend to be expensive, and instead using cosmetic fillers. This is very dangerous, because replacing things like this can lead to surgeries going very wrong, but even this is positive for private equity because it means more reparation surgeries and visits are to be expected. A common case seen is a patient getting infections from inadvertently blocks of blood vessels being left with dead sections of skin. How does this even happen to the point where it is becoming more prevalent than ever? Well, first is the non-disclosure agreements where doctors can't voice their concerns or opinions, and then there is the private equity firm also giving more authority to physician assistant. This comes as a method to deal with clients faster in order to get more visits per day. When assistants are being given roles that were exclusive for doctors, you are going to find higher volume in mistakes. They have not completed needed training and requirements to perform certain types of procedures, but management only cares for increased foot traffic. If a patient gets sick or worse, that is good news for them. All they have to do is keep the same percentage margins the same and under the radar so as to not gain a lot of attention from the public, so they can keep operating under the same mantra, even if it means killing people or substantially lowering their quality of life. And finally, the last step is when cost cutting has grown to a point where it can no longer be reduced. This is where things go absolutely crazy, so please buckle up because I am about to walk you through serious uncharted territory. When offices no longer see growth year over year, private equity tends to want out. As such, they sell off the offices, medical records and patient lists to other groups. This creates a black hole in the industry which will start becoming more prevalent in years to come, and here's why. Surviving chains get a huge pile of debt they struggle to pay when others start closing business. You see, when private equity doesn't find a buyer, they literally outright default on payments, which then get passed on to other lenders, who then increase their own margins by lowering staff salary. You know how a couple of minutes ago I said that people who sell their business or enter into agreements with private equity get screwed in the end? This is where, you see, once they monopolize regions, they will either lower your salary as a way to cut business, or they will close your office once they default, leaving you unemployed. Given that there is only a limited amount of people at a certain time seeking medical help, this is a huge problem for you, especially given that staff numbers are cut and maintained low at clinics in order to keep costs down. You will find it hard to find a job as competition will be high, even if you have decades of experience, because you will tend to ask for more money for all that experience when the private equity appointed management will see someone without experience as more lucrative since they aren't asking as much. There is no win in this industry, and by exacting the same business model that they use for the housing market, which always ends in a bubble and a subsequent crisis, as well as on the stock market, they are literally seeking to destroy the healthcare industry little by little. Guys, listen to me. What we talked about today was the relatively small sector in the healthcare industry that is non-essential, like dermatology clinics. This is just one video on this as a way to introduce you to how Wall Street is expanding into yet another sector of the economy in order to manipulate it, exhaust all the profits and then crash it and call it a day. If you think this was bad, wait until we get to subsequent videos. I think this is a good place to stop. Thank you all so much for making it to the end of the video. I have tons of content for you guys, to expand on healthcare as well as supplement you with more housing videos. We haven't even gone over insurance either. Stay tuned for more. Again, I appreciate all the love and support you guys have shown. Thank you for sticking with me to the end. Remember to comment and let me know what you think. It's literally all I can ask for you in return for making the video. If you want to support me and this channel a bit further, I have provided links which will be in the description for donations and a Patreon if you would like to pledge a monthly donation of any kind. This support really goes a long way for me, guys. All money is spent on improving equipment and other parts of the channel so that we can continue to upgrade the quality of Simulate and Trade. It is my source of income as I am doing this full-time now. It makes a huge impact and difference, so if you are able and willing, do consider it. I will see you guys later today. Until then, keep on buying the dip and holding to the moon.